Right now, an internal report circulates between a handful of central banks and defense ministries. Its working title is simple: Sequence Delta, Army, Money, Debt, Termination. The document tracks one repeating pattern over roughly 2,000 years. First comes military dominance, then control over trade routes, then reserve currency status, then an expanding wall of debt, and finally a financial break that looks like an accident from the outside, but from inside the system reads like a mathematically inevitable exit. At the end of the report, there is a dry note. The United States is not an exception, it is just the last line in the table. Roughly speaking, this cycle breaks into 5 phases. In the first phase, an empire does not count money. It counts divisions, ships, and garrisons. In the second phase, control over seas or key land corridors turns into a monopoly on trade. In the third phase, the empire's currency becomes the default unit for contracts, commodities, and reserves. In the fourth phase, the state starts to treat its own debt as an unquestioned asset rather than a risk. In the fifth phase, the market simply stops playing along. After that, you get a reset, a new hegemon, and a new cycle. Part 1. How armies turn into reserve currencies. To see where the United States sits today, the report does not start with Washington. It starts with Rome, Spain, the Netherlands, and Britain. Those systems ran the cycle already. Roman legions first took territory by force, then converted it into tax and tribute flows that created the denarius zone. At some point, military spending became so large that the empire stopped counting the full cost of war, because the coin was still accepted everywhere. As long as the coin moved, the campaigns could continue. The Spanish crown in the 16th century followed the same logic, but with silver instead of taxes. The silver stream out of Potosi allowed Madrid to finance wars against France, the Dutch, and the Ottoman Empire without immediate tax revolts at home. When the army wins, creditors are always willing to extend one more loan on the basis of victory tomorrow. At the dominant stage, military power creates an illusion of infinite resources. The problem is that this resource carries a time lag. Expenses are fixed today, but the consequences of debasement arrive a generation later. The Dutch Republic rose on its fleet. Here the military component looks more commercial. Armed ships escort convoys, protect trading posts, and control choke points, like the Strait of Malacca. But the logic is the same. Whoever secures the routes, writes the contracts, and decides which currency those contracts use. The fleet is armed scaffolding for the future reserve unit. The British Empire pushed this linkage to industrial scale. The Royal Navy ensured that almost any large trade operation touched a British-controlled node. From there, it was natural that the pound sterling became the convenient settlement medium. No one needed to announce a doctrine. If your ships are the ones that keep the major sea lanes open, your currency becomes the one everyone holds by default. The United States entered the same logic in the 20th century. First as the industrial base for allies, then as the key military power in Europe and Asia. A network of bases in dozens of countries is not just geopolitics. It is infrastructure for confidence in the dollar. If your military effectively underwrites global order, the world holds liquidity in your unit. At that stage, very few actors ask how much the insurance policy itself really costs. Part 2. From trade routes to a privileged unit of account. Once the military layer moves into the background, trade routes come to the front. Here the cycle becomes more formal. Rome controls Mediterranean ports, and the denarius becomes a natural unit for settlement. The reason is simple. If the major goods move through your harbors, it is efficient to price them in your money. No decree is required. It is a byproduct of logistics. In Spain, the Atlantic lanes to the New World play this role. Silver and gold moving through Seville give the impression of hard money. Merchants from London to Naples accept the Spanish dollar as something more reliable than the coins of minor princes. The pattern is clear. The army protects the convoys. The convoys create a near monopoly on bullion, and the bullion reinforces the role of the coin as an international standard. The Dutch push this principle into financial engineering. They do not just control routes, they build instruments around those flows. Credit, a formal exchange, long-dated contracts. When you combine a fleet, a developed financial system, and a web of trading posts, it is natural that the guilder becomes the working currency of the European merchant class. Again, it is not a political imposition. It is the sum of infrastructure effects. The British repeat the pattern through London. Ports, marine insurance, telegraph cables, then global banks. The pound turns from a simple means of payment into a reference point. This is a classic reserve phase. Other central banks hold part of their assets in sterling because it is both settlement medium and political signal of alignment with the system. The United States dollar enters the table of history through Bretton Woods. Formally, it is the anchor for other currencies, linked to gold. In practice, it is the unit for oil, grain, and industrial goods. When oil is priced in dollars and the sea lanes are secured by the same country that issues those dollars, the army trade currency loop closes. After that, debt steps forward. Part 3. Normal financial logic before an empire bends it. In a normal economy, debt is a tool to smooth cash flows, not a replacement for real output. A state borrows for infrastructure, for wars, for temporary shocks. The mechanics are straightforward. There is revenue, there is spending, and there is a ceiling beyond which creditors demand a premium. For non-hegemonic states, that ceiling is firm. The standard sequence runs like this. First, the budget is announced, and the planned deficit is laid out. Second, bonds are issued and taken up by banks, funds, and foreign investors. Third, audits and statistics track the path of the debt stock. If debt grows faster than the underlying economy, ratings tend to move down, yields move up, and the government must either cut spending or refinance on tougher terms. It is a feedback loop designed to impose discipline. In an ideal setting, the control chain looks like this: declaration, audit, reporting, regulatory response, market sanction. If a government manipulates its statistics, independent auditors and institutions will detect the gap with some delay, but they will detect it. If debt crosses certain thresholds, the market demands either a higher return or some form of restructuring. Even a large state, if it lacks reserve status, must live inside this logic. A simple analogy helps. Imagine a household taking a mortgage. The first loan is fine, the second, for renovation, may be fine as well. But once the family starts taking new loans just to pay interest on old loans, debt stops being a financial tool and becomes a forward signal of insolvency. For states and empires, the principle is the same. Only the scale and the time lag differ. The divergence starts when the state's currency becomes a reserve for others. From that moment, the disciplining loop weakens. If the whole world holds your bonds by default, the market takes longer to punish you for crossing the normal limits. This creates a temptation to use the reserve privilege to stretch the prosperity and the wars for another decade or two on borrowed time and borrowed money. Part 4. Anomalies. When rules stop working the way they should, this is where the investigation hits the core. Every empire that reached reserve status shows the same distortions. The first anomaly: the interest cost on imperial debt stays low far beyond what would be normal for any other borrower. In Britain's case, the stock of obligations before the Second World War would have forced a default or a restructuring on a colony. London kept rolling it because sterling was the backbone of the system. The second anomaly: markets look past military spending as long as the empire controls the trade architecture. For a regular country, a sharp rise in defense outlays raises questions and pushes borrowing costs up. For an empire, investors read it as a stability premium for a long time. As long as the deployment footprint does not visibly shrink, debt backed by force is treated as safer, not riskier. The third anomaly: part of the imperial debt is never really meant to be redeemed in full. Rome turned provincial taxes into a mechanism for permanent transfers to the center and tried to paper over the strain with more coinage. Britain at a certain point lived on a constant rollover machine, where new issues washed away old ones. Modern, long-dated United States treasuries serve a similar structural role. Few serious actors expect all of that paper to be repaid down to zero. They expect endless refinancing. The fourth anomaly: when competing trade blocs appear, the empire's debt keeps growing as if the monopoly were intact. Spain kept financing wars when Dutch merchants had already pulled part of the flows out of its orbit. Britain did not materially bend its debt trajectory even after it was clear, post-First World War, that the economic center of gravity was shifting toward America. This is the moment when financial inertia and political culture detach from the real map of power. The fifth anomaly: official institutions either deny the problem or describe it in abstract terms, or fall silent. The sequence is predictable. First, you get calming language about temporary imbalances. Then you get dense formulations about transition periods. Then you get a change of topic. Rome, Spain, the Netherlands, and Britain all ran through this rhetorical phase before the actual correction. Part 5. Where the United States sits in this table, overlay this matrix on current data, and the picture is unromantic but clear. The United States is no longer in the army phase. That part of the system is mature. It is not in the trade routes phase. Globalization and digital networks have weakened any pure monopoly. It is not in the creating a reserve currency phase. The dollar has been the de facto anchor for decades. Structurally, it is in the phase where debt is being built on top of that reserve status. The federal debt of the United States, relative to its economy, is now in the band where the Dutch and the British systems already showed structural vulnerability. Interest payments take a growing share of the budget, but the market does not punish aggressively yet because the dollar is still the main reserve. That is the same anomaly we saw in earlier cycles. The price of risk lags behind the true profile of risk. At the same time, there is a slow but measurable diversification of reserves. Some central banks push gold holdings up. Others sign bilateral deals in alternative currencies. This is not a collapse of the dollar, but it is an early-stage shift away from a world with a single unquestioned anchor toward a world with several large anchors. In past empires, that stage always arrived earlier than the political elite was ready to admit. The military component sits in the same logic as before, maintaining a global network of bases, running operations on more than one theater, and honoring security guarantees all rest on the assumption that debt financing will remain cheap enough. Historically, that assumption has been the weak point in every empire's endgame. Not because the army fails on the battlefield, but because the fiscal base under the army erodes. Part 6. Hypotheses. System error or deliberate choice. At this point, the report lays out two lines of interpretation. The first is the system inertia hypothesis. Under this view, there is no grand plan, just a series of locally rational choices. Politicians respond to voters who dislike austerity. Voters have grown used to a standard of living supported by cheap credit. Defense budgets are framed as the cost of order. The reserve status of the dollar makes it easy to believe that the ceiling is higher than the models say. The end result is a trajectory no one drew on paper, but everyone contributed to. The second hypothesis is more uncomfortable. It assumes that the groups steering fiscal, monetary, and defense policy understand the empire table very well. They know that the cycle has a terminal phase. Instead of breaking early, they try to maximize the payoff during the transition. Move a share of wealth into hard assets, jurisdictions, and structures that sit outside the main risk zone. Convert part of nominal public debt into private claims on real resources. Shift future losses outward onto allies and the global periphery. In that model, debt is not just a problem, it is also a tool for exporting the eventual cost of correction. What kind of evidence could distinguish between these two readings? Under the inertia scenario, you would expect policy to look inconsistent, driven by short electoral cycles and full of internal contradictions. Under the strategy scenario, you would expect to see alignment between defense deployments, debt issuance patterns, and the timing of large private asset shifts by insiders. In both cases, leaks, court records, lobbying disclosures, and investigations into conflicts of interest become critical. Part 7. Global observation and the open question. Global institutions are already tracking this path in their own language. Multilateral lenders, rating agencies, research teams at foreign central banks. They all log rising debt, sustained military commitments, and gradual reserve diversification. Official phrasing stays cautious. Reports speak of structural deficits, elevated vulnerabilities, and the need for medium-term consolidation. No one uses the word empire, but the numbers do not need metaphors. Markets, meanwhile, sit in a waiting stance. Large funds still buy United States debt because the alternatives do not yet offer the same depth and liquidity. Regulators and other capitals weigh the risk. Exit too early and you pay an opportunity cost. Exit too late and you absorb more of the adjustment. It is a tense equilibrium where everyone can see that arithmetic and politics are drifting apart, but no one wants to take the first visible step. Reduced to a single sentence, the internal summary looks like this. If this is mostly a technical error of an overgrown system, the United States economy will face a painful but manageable correction. If this is a conscious choice to extend the imperial cycle through debt as far as reserve privilege allows, the the global financial architecture will move into a phase where its rules are rewritten. The final question to the viewer is direct and deliberately unresolved. In this sequence of army, trade, currency, debt, and end, where do you think the United States stands today, Rock, and how confident are you that the people in charge are prepared to stop the cycle before arithmetic does it for them?